What's going on, guys? It's Nate Clark, the Skydiving Real Estate Agent, your Central Texas Realtor. Hope you're having an awesome day. Got some interesting information here. So let's go over our local market numbers for the last week from November 2nd to November 9th, 2022. So first off, we know the Fed raised the Fed funds rate 75 basis points last week, and this doesn't translate directly over to mortgages because mortgages are kind of expecting what the Fed's going to be doing and bake that into the cake, so to speak. The 30-year mortgage right now is trending at 7.906%, highest we've seen it before, almost 8%. Looking at the Austin Board of Realtors, there were 786 new properties that came on the market in the last 7 days, 1821 that dropped their price, so about twice as many price drops as new listings. There were 233 that expired and came off the market unsold, 641 that closed in the last 7 days. We're sitting at 4.99 months of inventory, which is a drop from 5.1 months last week. Anything over 5 months favors buyers, anything under 5 months favors sellers, so we're kind of wavering around that balanced market level. Average listing sold at 97.9% of its list price, and the median sales price was $459,990. Looking at Central Texas, we had 570 new properties that came on the market, 672 that dropped their price, a little bit less price drop activity than in Austin, 152 that expired and came off the market unsold, and 341 that successfully sold in the last 7 days. Inventory went up 0.18 months. We're at 4.13 months of inventory in the Central Texas MLS. Listings on average sold at 99% of their list price, and the median sales price was $292,250. Anytime we see interest rates get spiked, the luxury market bears the brunt of taking that impact, and especially for stuff, $300,000, $250,000 below in that range, it does a lot better in times like these. San Antonio market, there were 873 new properties that came on the market, 1162 that changed their price, 178 that expired and came off the market unsold. We had 649 that sold in the last 7 days. Inventory went up 0.22 months. We're at 4.61 months of inventory in San Antonio. I got this super interesting article that I was reading earlier, and I wanted to share with you guys some of the information on it. Whenever we're looking at the direction that the market may be going in, there are two big indicators that we have for forecasting. One of them is going to be months of inventory, which we cover weekly, and give us an indicator as to how crazy the market's getting for buyers and sellers. Another indicator that we have is pending contracts. Pending contracts is actually even a leading indicator to months of inventory, because months of inventory relies on closings, and if there are going to be far fewer closings in the next 30 days, we're not going to realize that just by looking at the inventory, but when we look at pending contracts, we'll see that they're way down. So as a whole, year over year, we've seen a lot less pending contract activity in 2022 versus 2021. In July, we were about 25% down versus contracts in July in 2021. It dropped to 24% in August. And as soon as the Fed started doing those jumbo rate hikes, one after another, we really saw that start to spike. So in September of this year, there were 29% fewer pending contracts than in September of 2021. And in October, so we just got this data in for last month, that dropped 40%. So we're really sitting at 3/5 of the transactions that we were the same time last year. Now, all that's super interesting, but a factor that's also not very often talked about that really does have an impact on if prices are going to fall or if they're going to stay level is the number of sellers that are selling by choice versus the number of forced sellers. Now, a forced seller is somebody who, if they're not selling at the price that they're at, they have to drop their price. They have to sell, whether they're moving out of state, they're moving for family, they've got something with a health or job or some issue that's making them so they have to sell. If they can't sell at this price, they're going to have to slash their price and sell at a lower price. What we're really seeing is far more sellers choosing to come off of the market and withdraw or cancel their listing to wait until we have more stability and lower interest rates in our market, rather than having to slash their prices. Now, this is representative of the fact that homeowners have way more equity in their houses right now than we did in 2008. A lot of people are expecting some kind of cyclical downward spiraling crash where everybody's getting foreclosed on or short selling their properties, but I don't think that that's going to happen when you actually look at the data. I hope you found this information valuable, and I'd love to hear your thoughts if you want to leave a comment down below. Do you think that we're going to see a huge crash in prices, or do you think we're going to see a lot more sluggish activity over time until the Fed starts pivoting and lowering those interest rates? If you like the video, click like. If you want to see more like this, hit subscribe. I hope to see you in the next one.